What the just happened? I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, China strikes back in shocking retaliation to U.S. tariffs. You're not going to believe what China just did. And we have new evidence that the U.S. labor market is getting weaker. I'll show you why retailers all across the country are panicking as we head into Black Friday. And are we about to face a massive liquidity crisis? Wait till you see the Fed's latest report. Now let's head over to Bloomberg, where we picked today's story up with a headline: as China companies cut foreign currency debt just in time for Trump. And one of the issues we face with the dollar being a global reserve currency is people in other countries borrow in dollars. Now, it's not normal to see Americans borrowing, say, yen or euros or yuan or some other foreign currency, but this is relatively common practice when you're in another country, particularly when the dollar is a reserve currency, because in global trade you need dollars. That's how settlement is made, particularly in trade. So what happens is you see a rise in dollar-denominated loans. Now, normally this isn't an issue, because what happens as trade expands, well, more dollars are created, and there's no issue paying on these loans. But China's power move now is to tell the U.S., well, you want to enact tariffs? Well, we're going to cut our dollar demand down as we pay off our debt. The country's foreign currency bonds, excluding those issued by the government, now total a mere $654 billion in principal value, the lowest since 2017. The plunge partly resulted from waning appetite for foreign currency debt after a series of interest rate cuts by Beijing made local funding much cheaper at a time when the Federal Reserve remained in its policy tightening cycle. Well, one reason, again, is the fact that rates in China are lower. That there's another issue, because dollars are created by the global banking system through global trade, and that's how we get more dollars in the system. So if you're going to see any evidence, in this case tariffs would be one of them, that global trade is going to slow, well, that means there's going to be fewer dollars in the system. The dollar is going to go up higher in value and make it more expensive for those holding dollar-denominated debt to get the dollars. They need to pay it down. So that means in a staggering response, now we're seeing, of course, Chinese businesses say, look, we're not going to keep a bunch of these loans around. We're going to pay them off. And that means demand for dollars is going to weaken, and eventually that could threaten the dollar as a reserve currency. The lighter foreign debt pile may offer some relief to the yuan, which is under increased depreciation pressures ahead of Trump's return to the White House. In a taste of what's to come, the president-elect roiled markets again this week by saying he would pose an additional 10% tariffs on Chinese goods. And you look at it from the fact that if you're trying to pay on these dollar-denominated debts, you're facing a potentially increasing dollar, making those debt service costs higher, while if you refinance into local debt that's expected to weaken, well, it could make those debt service costs a little bit less. This being, again, what I consider a pretty powerful message back to Trump, but from China, saying, hey, wait a minute, you can go ahead and put all the tariffs you want on, but when we don't want your dollar anymore, well, watch out. This will help Chinese companies handle risk from foreign debt repayment and currency volatility after Trump takes office. Businesses will turn more cautious toward raising foreign currency debt in the coming years with a focus on the health of their balance sheet. So you start to look back at why did China and Japan start dumping treasuries? Well, they needed dollars. And now look what we're seeing out of China. We're seeing local companies borrow money in yuan, get dollars, and then pay down their dollar-denominated debt. All this is a big blow to the dollar supremacy at a time we need it to stay strong. But when we turn to the U.S. economy, we now face a big threat. It's all about the labor market, as continuing jobless claims now top 1.9 million. This is the highest in 3 years. At the same time that initial claims fell to 213,000 last week, the lowest since April of this year. And what we're seeing in a sign from companies here is they want to hold on to their labor because they believe the economy is going to turn around. You know, we look at every survey from the manufacturing sector down to the consumer level, and everybody was concerned about the election. Now that that's over, the popular belief is that consumers are going to come out and spend big. But when you look at the labor market, what it's suggesting is they don't have the money, they don't have the spending power. In fact, we heard from Dallas this week from the Texas Manufacturing Survey. What they suggested is that they have not seen it change because new orders actually fell following the election. Now they're saying, well, things in 6 months will get better. The question is, are things going to get better for the U.S. consumer? Well, it doesn't look that way because continuing claims again rose to 1.907 million. This is now the highest in 3 years. So is the labor market hot with initial claims at 7-month lows, or cold with continued claims at 3-year highs? What do you think? Is this the case, or do you believe that lower initial claims will eventually bring people off the unemployment line? Or do you think that more people hitting the unemployment line and staying there is going to drive a decrease in consumption, put more people out of work? Weigh in the comments below. I'd love to know what you think, because as more people lose their job, they're going to need to make some money, and we've got the answer for that. Maybe you like to trade machine positioning, or maybe you like to trade momentum. Here's a recent trade on DBA. This is agricultural commodities, and it's up now 4.77% after yesterday's close. What is our CTA Time Pro? Well, every day, hundreds of billions of money is traded by machines based on algorithms, and we've got those algorithms, and what we do is we look for when machines are in the wrong position against the trend of the market and they're forced to buy, and we signal this to our subscribers, say, look, the machines are coming, you need to be buying here. But maybe you like to trade momentum, but you find you get in late, you get out early, you're bouncing all over the place. Well, we look at momentum over long periods of time, but we run a proprietary overlay what helps make our entry points much better. You get the reports, the tradable signals, my opinions on the best trades. You get full backtest data. That's right, we backtested our reports. We know which trades historically have a 50% chance or greater of generating a positive return, and we tell you each and every one of those. Not to mention, I'll show you my trades. You want to know what I'm trading, why I'm trading? Well, I disclose that as well. We give you stop loss levels to help control your risk, full tracking of all trades and returns. Here's the best part, 30-day free trial. Start making money, because what's going to likely happen is continued claims are going to drive initial claims. What we see throughout history, going back all the way to the 1970s at the inception of the data, we see where continued claims go in blue, that initial claims will eventually follow. And right now we see that initial claims are relatively low, now back at the lowest since April of this year, but continued claims continue to run higher. This is dangerous for the U.S. economy. And one of the reasons we see retailers are so worried about Black Friday is because when people get on unemployment and they get stuck there, well, they naturally, their spending power decreases because their incomes go down. But even worse, the longer they're on employment without the prospect of finding work, they cut back even more. This hits the discretionary side of the economy at a time when retailers have massive amounts of inventory they need to move. They've been discounting and still not moving, which means eventually they're going to be laying off more people too. And here we can see the effects of rising continued claims against real retail sales. This shown as advanced retail sales less the consumer price index. That's shown in red on a year-over-year rate of change. And you can see as Americans hit the unemployment line and get stuck there, the natural response is a decrease in spending. You see that deceleration in real retail sales heading right into the dot-com bubble. We can go back to the global financial crisis, which for retailers started all the way back in 2006, as we saw a deceleration in demand matched by an eventual rise in continued unemployment claims. And then we turn to where we are today. We've seen 3 years now of negative real retail sales, and that matches right in line with where we see a bottom of a continued unemployment claims that are heading higher and threaten to break over 2 million, which I think is a very dangerous point for the U.S. economy, because what we see is a snowball effect. As spending power from more Americans decreases, well, what it means is the incomes for other Americans go down, hours get cut, jobs get cut, and it all then turns to the manufacturing sector, which today we saw durable goods orders disappoint in October, now stagnant for 19 months. I'm going to show you why. After 2 months of declines, U.S. durable goods orders rose 0.2% month over month. This again is the preliminary data, which we know tends to get revised down. But notably, given the stagnation, this blip pushed up orders to a 5.3% year over year on a non-seasonally adjusted basis. But of course, we care about the seasonal adjustment when it comes to new orders. And here you can see that they remain slightly positive, this shown in blue, against real retail sales. That's still shown in red, both on a year-over-year rate of change. And what we see is a great relationship here. As demand for retail sales goes down, you see that deceleration. Well, what that turns into is a lack of need for new orders. So if you're not moving your inventory, well, you don't need to order more of it. And next thing you know, from the manufacturing perspective, you see hours get cut, you see new orders orders go down, you see backlogs get worked through, and next thing you know, you see people hit the unemployment line. And sure enough, that's what we're seeing once again, going back to 2006, as you saw that slowdown in real retail sales. Well, what it led to was a slowdown in manufacturers' new orders. And right now, everybody's hoping for a big turnaround in manufacturing, but it's all on the back of U.S. consumers, which was interesting. We saw in the Texas survey, what we found for manufacturers is all of a sudden they said, in 6 months, we think we're going to be booming. We think we're going to be at capacity, massive demand. But if consumers don't come out and spend, particularly over Black Friday and through the holiday season, what we're going to see in 6 months isn't a boom in demand. It's going to be a massive increase in layoffs. But are we facing a massive liquidity crisis? Well, we turn to the Fed now as officials mull reverse repo rate cut to control the benchmark, as perhaps things are now going wrong. Balances at key Fed facility have dropped to about $2.4 trillion since their December 2022 peak, though the pace of declines has slowed in recent months. On Wall Street, the sum of cash parked on the reverse repo has long been considered a barometer of excess liquidity, suggesting the more money that's in reverse repo, then we have ample liquidity in the system. In this case, we're seeing this get drained down to near zero, suggesting we could be on the verge of a liquidity crisis. And this is a useful gauge for market participants as the central bank continues to unwind its balance sheet via a process known as quantitative tightening. Well, there's some issues with all of these statements. One, it has nothing to do with excess liquidity. In fact, it has nothing to do with quantitative tightening because the Fed's rolling off notes and bonds, and where reverse repo comes into play is in the bill market. Now, yes, is the Fed rolling off some T-bills? Yes, it's only incidentally, and that was only before they reduced the amount of quantitative tightening. Now there's no need for that. But what we're seeing here is really an issue in money markets where there's a collateral shortage in the T-bill market. Because when you look at money markets, they have to back what the interest they pay with consumers with an interest-bearing asset. That's T-bills. So when there's a shortage of T-bills in the market, they go to the Fed and they give them cash at an overnight lending rate, and that's how they get the interest to pay money market holders. So what we're seeing now from money market funds is they believe interest rates are going down, which is why they're locking in 3 and 6 month T-bill rates, because they believe the Fed's going to continue cutting. This isn't about liquidity. This is about the fact that rates are going to keep coming down. And here you can see the effects of this as we look at 6 month T-bill rates shown in red against the overnight repurchase agreements in blue. This isn't a liquidity issue. This means there's now enough collateral in the system, and it also suggests that money market funds believe that rates are going lower. They want to lock these rates in while they can and make a little bit more money off the spread, and you can see overnight reverse repo on its way right back to zero. And officials last tinkered with the tools when it raised the rate in the reverse repo facility in June of 2021 as a dollar glut. So you got to start to get to the real information here. In short-term funding markets, outstrip supply of investable securities and weighed down front end rates. And so what's not really the issue of what weighing down front end rates? What it meant is there's too much cash in the system and not enough collateral. Now we're seeing that there's a balance between the two as cash amounts start to equal the collateral in the system. And what we're seeing is, again, money market funds locking in longer term rates within their guidelines of what they can buy. That's driving down short term rates and putting pressure on the Fed to cut even more. And here you can see the relationship between 6 month T-bill yields in red against the federal funds rate in blue. And what we know is the funds rate generally tracks 6 month yields. And what we can see in every instant going back to the 1980s when the data series originated, the T-bill yields lead the Fed each and every time. So what we're seeing from the Fed's perspective isn't a liquidity crisis. What we're seeing is the bond market telling the Fed that you're going to cut and you're going to keep cutting, despite the fact that you actually only believe you're going to make a couple cuts next year. Well, bond market's saying you're going to do a whole lot more than that. But China's not the only one to strike back. We now turn to Canada as Trump tariff shock sparks an all-hands response in the Trudeau war room. Trudeau has called a meeting of the country's provincial leaders for Wednesday to discuss how to handle the incoming Trump administration. The country's two largest provinces are the most exposed. That's Ontario in the auto manufacturing hub. And this is a problem because we're seeing demand for automobiles already go down, and in a recession it's going to get worse. I mean, what have we seen so far? The companies that sell auto parts are closing stores. They're closing distribution centers. They're saying demand has plummeted. But what about the new vehicle sales? Well, we know that baby boomers aren't buying as many cars because they're headed into retirement and now going from about 2.5 cars down to 1.5 or even 1. What we're seeing is the hybrid or work from home people. They're not replacing their cars as often. So overall, demand for vehicles is plunging. This is not good for Canada to begin with. And how about the powerhouse of aluminum and aerospace? That's Quebec. And both of those represent more than half of gross domestic product. Well, if we do head into recession, well, demand for aerospace metals will go down as well. And that is a dangerous part for Canada. They're very reliant on the U.S. economy here. They're worried about tariffs. Well, they should be worried about the economy headed down. I think that's what Trump has always done quite well, which is impose a tariff and have everyone come hat in hand begging for their exclusion from the tariff. Absolutely, there should be a way here to give Trump a win, which is something he wants, save face, and not have that 25% tariff apply. So what Canada is saying is, look, we know this is coming. We've got to do some things, and then we've got to go find a way to negotiate with President-elect Trump to get that tariff removed. Give him some way to say he won, and at the same time not destroy the Canadian economy, because if those tariffs stick, well, it could mean Canada's heading into recession. But the problem is the world is already headed into recession. But how about a little bit of a bright spot as U.S. home purchase applications rise to the highest since February, as potential home buyers, now that the election has cleared, come out and buy. But was it really due to the election? Well, a measure of purchase applications jumped a whopping 12.4% in the week ending from November 22nd. While the percentage gain was the strongest since early 2023, the data is prone to large weekly swings around holidays, but some other pluses included strong economy and a pickup in for sale inventory, the group said. While the NBA didn't cite this month's election as a factor, there's a key point. Several builders in recent earnings calls also had to blame uncertainty over the presidential race for keeping buyers on the sideline, but the key part of this is a pickup for in-sale inventory. So what this tells us is that builders were sitting on previously built homes for too long, offering big discounts to pull in people who are on the sidelines and get them to buy. Now, could this be a bright spot? Could this be the green shoots and an early sign that the U.S. economy is bottoming and turning out? Well, it's entirely possible, but based on what we're seeing in the U.S. labor market, what I would suggest is not only are we in the early stages of a recession, but right now that there's nothing that's changing that trend. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.